Good evening, everyone. This is Waris Karim again with another presentation on cost or managerial accounting. This video is particularly for my Accounting 219 managerial accounting students at Alabama A&M University. But I'm sure anyone interested in cost accounting, especially job order costing, is going to find it useful. All right, so this is our topic tonight. It's based on chapter 3 of Garrison, Noreen, and Brewer textbook, the 17th edition. You can see job order costing, cost flows, and external reporting. A week or so ago, I did a video on chapter 2 of the book. That was job costing, computation of unit costs. In that video, we talked about accumulation of job costs. And I've shown that job costing is simple and easy. All you have to do is accumulate the particular labor, material, labor, and overhead costs associated with a particular job. So any resources or all the resources that are deployed to completion of a particular job, to successful completion, that is going to be the job cost. So job costing, we've shown, is very useful in making quotations, in preparing bids, like when you compete with other organizations, or when you do your own pricing, or you plan your operations, or you do your financial reporting now, what you're going to see. Because one of the things we do in accounting is income determination. So we need to know how much money we made from a particular job or from each of those jobs. But I think it's more important in cost accounting to estimate the cost before even embarking on a job. Anyway, so chapter 3 is about the accounting aspects of job costing. So we start with this. The cost flows, you can see these are the elements of what I call accounting cycle. So I gave it a name, the job cost accounting or job order costing accounting cycle. So like the financial reporting accounting cycle or financial accounting cycle, we prepared a job costing accounting cycle. So what it involves is all the accounting aspects or all the transactions right from the beginning, right from acquisition of materials, direct and indirect, that is, all the way up to completion, not just the completion of the job, but actually sale of the job, or earning the revenue and finding out how much profit you made from the job. So all the accounting, all the transactions involving a particular job are going to be covered in this topic, in this video. So this is how we start. The first transaction that happens is purchase of direct and or indirect materials. So any organization, especially construction companies or painting companies or companies who provide outsourcing services. So whoever has job costing relevant to them, or whoever performs jobs, will have to obviously purchase direct and indirect materials to later assign those materials or to deploy those materials to different construction sites or different job sites. Then we issue those materials, issue direct material and or indirect material, then assign direct labor costs to particular jobs, then accumulate all the overhead items or all the indirect costs, indirect labor, indirect material, indirect expenses. So all indirect costs accumulation, that's the next step in the accounting cycle. Then apply appropriate or the right amount, proportionate amount of overhead to particular jobs. See, in the step before, we did accumulation, and now we're going to apply that, the appropriate amount of overhead to particular jobs or a particular job. And they record non-manufacturing costs, then transfer work in process to finished goods. Because once the job is ready, job is complete, then it's not going to be in work in process anymore, because all the work associated with the job are all complete. Now it's ready to go to our finished goods warehouse, or to the actual display, to finished goods inventory. And then once sold, transfer the job from finished goods inventory to cost of goods sold once it is sold. And finally, if there is any over or under applied overhead, which not a matter of if, is a matter of when, because in every possible situation, you'll actually see invariably you will end up with some over or under applied overhead. because you've been applying overhead on an estimated basis. So estimates are never going to be exactly the same as actual. So by the end of the year or end of the period, when you have access to actual overhead costs, now you'll find that you're either under applied overhead or over applied overhead. So if it is under over applied, whatever it is, you then have to do an adjustment to adjust your cost of goods sold for those over or under applied overhead. So these are the steps of the accounting cycle involving job order costing. So how many steps we have? We have 4 here and 4 more here, 8, and then this is our 9th one. Adjust cost of goods sold for over or under applied overhead. With these, we are now ready to actually do the journal entries, do the actual accounting for those. So this is what I have for you. The first entry is to record the purchase of materials, the purchase of direct or indirect materials. So whenever we purchase those materials, we debit materials inventory. We are doing perpetual accounting here, perpetual inventory costing, so perpetual inventory system. So record purchase of materials, we debit raw materials inventory and credit cash or accounts payable. If we already paid for it, then we'll credit cash. If we haven't paid for it, then we're going to credit accounts payable. So your first transaction is to acquire materials, both direct and indirect. No distinction here. So when you acquire materials, you purchase materials, you debit materials inventory, raw materials inventory. Let's make it more specific. Debit raw materials inventory, or the textbook here just calls it raw materials. It drops the word inventory, but you are open. I'm open to that, and I would prefer you to include the word inventory. All right. So debit raw materials inventory, credit cash if we have already paid for it, or accounts payable if we have not paid for it. The second transaction is issue direct materials to a particular job site. So I call jobs as projects. Let's say we are dealing with a construction company here who has 3 different construction projects going on. So we have site 1, site 2, and site 3, and we are sending materials, direct materials like bricks, cement, rods, all those construction materials to those job sites. So as we send some materials, we call it assignment, we debit work in process. So remember, any resource that goes in to a manufacturing process, until the manufacturing process is over, all resources are going to be added to work in process. So work in process is our basket that contains all the costs. All right. So as we assign materials to a particular job site or to a particular project, we debit work in process and credit raw materials or raw materials inventory, because it's coming from our raw materials and going into the process basket. So debit work in process and credit raw materials inventory. That's our journal entry number 2. Then we issue some indirect materials. Remember, those job sites, we not only issue direct materials, we also issue indirect materials. So as we issue indirect materials, this is our journal entry, and the journal entry is debit, this time not work in process, we debit manufacturing overhead and credit raw materials inventory. So from a materials warehouse, the direct ones are contributing towards work in process, the indirect ones are contributing towards manufacturing overhead. So keep an eye on this, on manufacturing overhead, because this manufacturing overhead is going to be dismantled a while later, and then part of it will be applied to individual job sites, to individual projects. So eventually, both direct and indirect materials, all these materials are going to be added to the particular manufacturing process, to the particular job. It may not be in the form of work in process. It may take a different name, but it will all be added. All the resources will be added there. Anyway, so the 3 journal entries on this particular page, on this page, the first one is acquisition of raw materials. Second one is assignment of direct materials to job sites, individual jobs. And the third one is assignment of indirect materials to individual job sites. When we issue direct materials, we debit work in process. When we issue indirect materials, like say cleaning agents, like polishing agents, materials that are not going to be included if you do a physical check, physical verification of the project or of the product, you will not see the existence of indirect materials, but you'll see the existence of direct materials. So direct materials and indirect materials, I think we've made the distinction clear before in the previous video. The direct costs or direct materials are the ones that are going to be traced, that are traceable in the product. So if I build a house is my product, all the direct materials are going to be visible, either visible or are going to be included in there. Some of it will be concealed, of course, not only visible, but the paint, the bricks, the insulation may not be visible, but the roofing will be visible, the windows will be visible. So all these are direct materials. Indirect materials are like the polishing, or maybe we spray some particular, we spray a particular agent, we polish. So a lot of, and we need tools that go, that disappear after the production process is complete. So those are indirect materials. As we send indirect materials to those projects, construction sites, we debit manufacturing overhead. Remember, don't debit work in process. So direct ones go into work in process, indirect ones go into manufacturing overhead. All right. Okay. The next one, the fourth step in the accounting cycle is assignment of direct labor costs to individual jobs. So we are now assigning direct labor. So again, work in process, debit work in process, credit wages payable or cash. If you have paid for it, then cash. If you have not paid for it, then wages payable. So direct labor cost is now assigned or included in the job cost in the form of work in process. Number 5 is accumulation of indirect costs. Accumulate all indirect costs to manufacturing overhead. Remember, we have had indirect materials already. Now there will be indirect labor and all indirect costs. So indirect labor is going to be added to manufacturing overhead, and other indirect costs in the next step are also going to be included in manufacturing overhead. So manufacturing overhead and work in process, these two are the receiving candidates. These two are our containers. The direct resources, direct material, and direct labor, they go into work in process. The indirect material, indirect labor, and indirect expenses, they all go into manufacturing overhead. They're both debited in different entries, of course. All right. So you can see here, accumulate indirect labor cost. The debit is manufacturing overhead. Credit is salaries payable or cash. Then accumulate indirect expenses. So not indirect labor. Remember, indirect material, indirect labor, and now indirect expenses like utilities, like water, like heating, like energy, gas. So for all those indirect expenses, we debit manufacturing overhead. See here, debit manufacturing overhead, and credit utilities payable or cash, rent payable or cash, or miscellaneous expenses payable or cash. All right. It could also include depreciation of the manufacturing plant, of manufacturing facilities. Remember, any depreciation involving direct manufacturing process, like the machines, the equipment at the factory, they are part of manufacturing overhead. But equipment depreciation or furniture depreciation or other like appliance depreciations that involve the headquarter, that involve support services like selling and distribution or administrative activities, they contribute to other overheads like selling and distribution overhead or general administrative overhead. They are not part of manufacturing overhead. They're also overheads, but they're not manufacturing overhead. They are non-manufacturing overhead. So in order to avoid confusion, what we have seen so far, we have seen acquisition of material, we have seen issue of direct material, we have seen issue of indirect material. Issue of direct material goes into work in process. Issue of indirect material goes to manufacturing overhead. Then we have seen issue or deployment of direct labor that goes into work in process. Then deployment of indirect labor that goes into manufacturing overhead, and assignment or deployment of indirect expenses, indirect expenses like utilities, heating, gas, water, telephone, all the indirect expenses and supervisory labor, like 4 floor supervisors, they all go into manufacturing overhead. You've seen this. Next one, step number 7, apply manufacturing overhead to individual jobs. Remember, we have in the previous couple of steps, we have accumulated manufacturing overhead. Now it's time to apply, to assign manufacturing overhead, or the proportionate amount of manufacturing overhead that is relevant to the particular job. So let's say it's job number 1, 2, or 3. So let's focus on just job number 1. And job number 1 is entitled or is responsible for maybe 10 hours of overhead. If we use labor hours as the denominator or as our allocation base, we could also use machine hours or number of units or any other acceptable allocation base. That's beside the point here. So the appropriate amount of overhead is now assigned to job number 1, and we are debiting work in process. See, we're back to work in process. So we are back to work in process via manufacturing overhead. So now direct material, direct labor, and indirect expenses and indirect labor and indirect material, everything is now in the bucket, in the same bucket called work in process. So now debit work in process, credit manufacturing overhead. This one. Now the manufacturing process is complete. The job is ready. Now transfer it from work in process to finished goods. So that also involves a journal. We're now debiting. Who's receiving it? The finished goods inventory is receiving it. So debit finished goods inventory. And who's giving it away? Work in process. It's not work in process anymore. It's a complete work. So debit finished goods inventory and credit work in process inventory. All right. So the house is now ready, or the project is now ready to go. And then we sold it. So once we sell it, we have this journal. We now have to transfer it from finished goods to cost of goods sold. Step number 9, transfer finished goods to cost of goods sold. And who's receiving? Receiver is debit. So debit cost of goods sold and credit FGI finished goods inventory. Okay, now the last one, I'm skipping the sale entry here. Of course, for sales, we debit cash or accounts receivable. For projects, I think it's more likely to be accounts receivable. So debit accounts receivable, credit sales revenue or sales. So that one journal I skipped because that doesn't involve cost. So number 9 was transferring the item from finished goods inventory to cost of goods sold. Now the last, cleaning up the over or under applied overhead. So as I said, there is invariably going to be some over or under application of overhead because the application was based on an estimate. The application rates are estimated rates. Now that we have access to actual data, so our actual overhead is likely to be different from estimated or applied overhead. So we may have under applied. In other words, our actual could be greater than what we applied, which is a problem, of course. Now that means our cost of goods sold is, the actual cost of goods sold is higher than what we thought it was. So we debit cost of goods sold and credit manufacturing overhead. If, on the other hand, if we have over applied, luckily, that we have either had a lot of activities going on or our estimated rate was higher than the actual, in that case, we debit manufacturing overhead and credit cost of goods sold. Means we are reducing cost of goods sold, which is going to be contributing to our profit. All right. So under application is a bad thing if you want to apply any value judgment here. Under application is bad, I believe. Bad because now it's going to contribute to my cost of goods sold. Cost of goods sold is going to go up. So all my plans could be shattered now. Or all my plans could be in disarray at least, because I had some estimated costs, and based on that, I may have priced it. I may have already submitted a quotation, and my customers have accepted that quotation, or they, in real world, they will have actually negotiated downwards. So we have now settled on a price, and now you're saying that the application rate was too little, too low, or the application amount was lower, or the actual overhead for some reason was higher. So if the actual overhead is higher, that means you have a situation of under application, which now is going to overload my cost of goods sold. So debit cost of goods sold, credit manufacturing overhead. Remember, manufacturing overhead account has to be cleared. And if we have, luckily if we have over application, that's a good thing. That means our actual profit from the job is going to be greater than what you thought it was, or what you thought it would be. And that is going to reduce our cost of goods sold. So cost of goods sold is a debit item. To reduce it, you have to credit it. So credit cost of goods sold and debit manufacturing overhead. So that's our 10th step, or the last step of the accounting cycle. All right. So what I've learned so far is that job order costing involves a lot of accounting, but it's not a lot. It's all the activities associated with the particular job. Because once you start a job, you have to complete the job. And to start the actual jobs, and most of the jobs we use examples of manufacturing industry, manufacturing, like construction, like building something. But even if it's small, like making coffee, making tea, see, before I made tea, I had to buy tea bags and sugar and cream, at least these three, and of course, I had to have water. So I had to buy those. So to buy materials, I debited raw materials inventory and credited cash or accounts payable. So the purchase is complete. Number two, I must have assigned some of those materials onto this mug. So when I assign it, it gets into work in process. So debit work in process for direct materials, credit raw materials inventory. Then I will have assigned some indirect materials to this. Maybe I cleaned this, I washed it before I poured in coffee or tea. So that washing is not going to be traced. You'd hope it is not. It's not going to be traced in my coffee. It better not, isn't it? So, but that did cost something, and that was indirect material, the cleaning agents, the washing up liquid, for example. So the washing up liquid that I spent in making this coffee is my indirect material. You got it? That's my indirect material. Or maybe some wiping, because when I poured in from the kettle or from my boiling pot to this cup, I may have spilled some water outside, so I needed to wipe it. So I use tissues, napkins to clean and dry it. So that's indirect material. See, the difference between direct and indirect materials, the main difference is that direct materials are going to be traced. If an engineer, if a chemical engineer now tries to examine what's in this coffee mug, they're going to find sugar. I do take a little bit of sugar and cream, milk, and tea, the traces of tea and water. They're not going to see any cleaning material here, not washing up liquid at least. You don't want me to mix it with any of my drinks. All right, but it is necessary. It is a necessary part of serving tea. All right, so indirect material, then where does it go? Someone has to pay for it. So it goes into manufacturing overhead initially. So all the indirect materials that are used, that are spent, that are sent to all these construction sites, all these production sites, someone is making coffee, others are making, say, sandwiches, making burgers, or cooking curry or baking cookies. Whoever is doing whatever they're doing, everyone consumes both direct and indirect materials. So all the indirect materials go into manufacturing overhead first, and then we know that there is an application rate, predetermined overhead rate that we have already determined in chapter 2. Well, ignore the chapter boundaries. The organization, the restaurant will have known that if a coffee takes 4 minutes, then for 4 minutes they have to pay for 4 minutes of overhead. All the electricity, all the energy, music, even the security, even the things that the coffee consumer is not ever going to come across, like the changing rooms, like the restrooms, like the plumbing that goes in, like the roofing. So a lot of, anything that was necessary to have this place up and running, to have a functioning restaurant, to have a functioning facility, a building where we can make tea or burgers or other means of products. All of them go into manufacturing overhead, manufacturing ones. And then there's some selling and administrative overhead as well, because there's accounting, there's auditing, there's advertising, there is distribution people, there are people who provide leadership, like the CEO or the board, So that's a, a totally different domain. But all those costs also go into some kind of overhead. We call it selling and distribution overhead. And the administrative ones, like the CEO, board, and other senior management people, their pay, their salaries, their vacation pay, their insurance, that go into administrative overhead. All right. So let's accumulate first all those indirect costs to manufacturing, the manufacturing ones to manufacturing overhead, and the non-manufacturing ones to say selling and distribution overhead or administrative overhead, and then credit payables or cash. All right. So first is accumulation, and then we have now deployed a little bit. So it took me say 4 minutes to make this cup of tea. So for 4 minutes of overhead, if we had a minute rate of say 10 cents or 1 cent, then for 4 minutes I applied 4 cents of overhead. So what do I do? I then debit work in process for those 4 cents only, because it took 4 minutes and our rate is 1 cent per minute. All right, so 4 cents of overhead go into this. So we debit work in process now. Remember, we already debited this little mug for material that it has contained, it has received, and also labor, direct labor. And now for the appliances, for the cooker, for the kettle, for the heaters, everything. So now work in process debit again and credit manufacturing overhead. So the total work in process now, every resource that went into making this product, this cup of tea, is now accumulated. So let's say it's 20 cents in total. Now 20 cents, once the tea is ready, then it is now, I'll be handing it to my waiters and waitresses, to our colleagues who are gonna serve it to the customers. Okay, so when they receive it, it becomes finished goods inventory, because now it's not gonna be in the kitchen anymore. It's now ready to be served. So our colleagues who, those beautiful colleagues who are involved in directly serving food from the kitchen to the dining tables, they have received it. As soon as they have received it, it is debit finished goods inventory and credit work in process, because it's now getting out of the kitchen. All right. Now, once it is sold, the food is now sold, then we already know the cost of those goods sold, cost of food sold. So let's say I sell this tea for 70 cents. I'm a reasonable, very reasonable person in terms when it comes to charging people. So I don't think I should charge any more than say 50 to 70 cents. So let's say the cost of my tea is 70 cents. So I debit accounts receivable or cash and credit sales revenue for 70 cents. But my cost was only 20 cents. So debit cost of goods sold from finished goods, because now it's not even finished goods anymore. Because when the sense of finished goods is that it is stocked somewhere. It is in stock. It can be stored. But once it's sold, it's not in our stock anymore. So we now debit cost of goods sold and credit finished goods inventory. All right. Then we found out that the 4 cents, now come back to the 4 cents of overhead that I applied in making this cup. Remember, we have been selling thousands of cups of tea and thousands of mugs of coffee. And for every order, it is impossible and inefficient. Not just impossible, even if it was possible, I wouldn't do it, because it would be inefficient to try to calculate accurately how much overhead goes into manufacturing a cup of tea or making a burger or making an apple pie. Why? You have better things to do. You don't want to spend 5 cents to count 4 cents. Remember that the fix should not cost more than the problem. Okay? All right. So we have not calculated, we have not bothered about the actual overhead that goes into making tea. We made an estimate that if it takes 4 cents, you charge 1 cent per minute. So if it takes 4 minutes, so it will be 4 cents. But now at the end of the year or at the end of the month, we find out that our total bill, total overhead is higher than our total applied overhead. Now, it could happen for a number of reasons. It could happen for wrong planning or wrong information about the actual costs of overhead. Maybe things have changed, the prices have changed, the prices of electricity have changed, the gas rates have changed, or your price plan has changed, or maybe you didn't have enough activities to fill in your total resources. Let's say with all the overheads that we have invested in, we are capable of making 100,000 cups of tea, or 100,000 minutes, 100,000 minutes of work. But the total activities that we had carried out in the restaurant all accounted for only 70,000 minutes. So that means we have applied 70,000 times 1 cent, 70,000 cents. Because our minute rate is 1 cent. Now we have a problem. This under application happened not because of poor estimates, but because of lack of activity, because of maybe our products are not as popular anymore, or we are ambitious in thinking that we'll be able to utilize 100,000 minutes. So if we don't have enough customers, if we don't have enough sales, if it might not have taken as much of time, So we may have thought that to serve the customers that we had, it would take us 100,000 minutes, but it may have taken only 70,000 minutes. So we managed to apply 70,000 minutes times a cent. But the actual bill is the actual bill. The actual rent has nothing to do with how many customers come in and go out. The actual rent for the facility, the actual insurance for the facility, the health insurance cost, the security costs, the heating costs, the cooling costs are all predetermined. Most of them are fixed. That's why the actual overhead is going to be more or less, is going to be different from applied overhead. So that will lead to over or under application necessity. So now if it's under applied, that means you have to load it to cost of goods sold again. So now debit cost of goods sold, credit manufacturing overhead. If it's over applied, if the opposite happens, then reduce cost of goods sold, credit cost of goods sold, and debit manufacturing overhead. With these 10 journal entries, you will have finished the accounting cycle. All right, so what we've learned so far is that the transactions involving our job are more or less predictable right from starting to purchase materials for the job until we sold the job. Okay, so that's one part of tonight's discussion. The second part is the preparation of the schedule of cost of goods manufactured and cost of goods sold. This is also going to be in your assignments and exams, so please, you better take a very careful note of this. So take a look at this video, at this page. What you see here is that preparation of the schedule of cost of goods manufactured and cost of goods sold. Now, fortunately, cost of goods manufactured is part of cost of goods sold schedule. So when you do cost of goods sold schedule, you will have already done cost of goods manufactured schedule. So the learning point, the key points here is to find out the raw materials actually used. So remember, this schedule is quite lengthy. It has probably 12 to 13 lines, rows, but I would say there's nothing here to memorize. You don't need to memorize anything. You need to understand and think and understand. Cost of goods sold or cost of goods manufactured means what? Means I was involved in a manufacturing process and I had some costs. So what are those costs? Cost number one is materials. So if I can estimate or identify the total materials used, not materials purchased or materials issued, but actual materials used in the project. All right. And then the labor actually used in the project and overhead actually used in the project. So used is important. So initially materials used, labor used, and overhead applied. Okay. So applied and then adjustment. Then once you carry out the adjustments for over and under applied, then overhead also becomes used, not applied. All right. So for the time being, let's look at materials used, labor used, and overhead applied. So up to this point, we have the total manufacturing cost. Materials used plus labor used plus manufacturing overhead applied. So these three together is your total manufacturing cost. And then just two adjustments. One is I call work in process adjustment, means beginning work in process is going to be added and ending work in process will be subtracted. So add beginning minus ending. And the second adjustment is finished goods inventory adjustment. So add beginning finished goods minus or subtract ending finished goods. That's when you have cost of goods sold. All right. So before you do the final adjustment, the finished goods adjustment, you will have already done the cost of goods manufactured schedule. So up to this point is your cost of goods manufactured schedule, and then up to the final point is your cost of goods sold schedule. All right, so these are the key points. Take a careful look. All right, let's go and do the actual schedule. It is fun. Remember, I told you that cost accounting is fun. Actually, one of my colleagues at a conference said the real accounting is managerial accounting. I disagree with her, but that was a very cute claim, and that means she really enjoys, and she wants her students and audience to enjoy cost accounting. And I think cost of managerial accounting is more logical, much more logical. You have a hands-on experience here, hands-on, like feel that there is material being deployed, material being used, labor being thrown in, and overhead being utilized to manufacture a particular product or to complete a particular project. All right. So what do you have? Let's start with direct raw materials purchased. So let's start with the purchase of raw materials, and in that, just use the purchase. Forget about the how much you used. Purchase of raw materials, and don't forget to include freight there. So if the raw materials cost was say $10, but if you had $2 of freight, then add that. So $2 would be added to raw materials purchased. Then do the adjustments for beginning and ending. Then plus beginning raw materials and minus ending raw materials. So what happens? Say I purchased $10 worth of tea bags. Okay, and let's say tea bags, sugar, cream, everything, all the materials that I purchased, that's $10. Plus, I already had $5 worth of those same materials at home. So now I have $15 worth of materials that are available for use. See, English is your language, your first language. It's not my first language. So you got to understand the meaning of it. Raw materials purchased, the $10 grocery bill, plus $5 worth of materials that I already had in my kitchen, in my pantry, or in the fridge. So that's $15 of raw materials available for use. Minus, after the manufacturing process is complete, so after all the dinner and everything is served, everything is cleaned, now I still have, say, $8 of raw materials in hand. So that's my ending inventory of raw materials. So subtract it. Then you have, what, 10 plus 5 is $15, minus $8 that you still have, or leftovers. So that means you used only $7 worth of raw materials to make the tea and dinner and whatever you did to complete all your projects. Okay? All right. So we have 10 plus 5, 15, minus 8, $7 of raw materials actually used in the project. Okay. Second is labor. And I had, say, three workers who I paid $10 per hour, and they worked for just an hour. So 3 times $10, $30 is my direct labor. See, same thing as you did in our journals. Now you just do it on a piece of paper and do the arithmetic. This is arithmetic. There's no accounting here. This is arithmetic, just adding and subtracting numbers. Okay. So raw materials purchased, $10, plus beginning was 5, so $15, minus ending was 8, so $7 of raw materials used, plus $30 of raw materials, $30 of labor used in the project. So 30 plus 7, $37 is my prime cost. We call it prime cost. Direct material plus direct labor. The two together is prime cost. Okay, now overhead. So add manufacturing overhead. Then what do you have? Manufacturing overhead. Now you have total manufacturing cost. Mind it, total manufacturing cost, not cost of goods manufactured. So total manufacturing cost is raw materials used plus labor used plus manufacturing overhead applied. Not actual manufacturing overhead applied here. See the word applied. So after prime cost, we have manufacturing overhead applied here. Applied. So that gives us total manufacturing cost. After that, what was left? Remember the two adjustments? One was work in process adjustment and the other was finished goods adjustment. So work in process adjustment means plus beginning work in process. If we add the beginning work in process, that gives us total work in process, total cost of work in process for the period. See, total work in process for the period. Total work in process means total things, all the resources that I put in, plus anything that was here when we started the day, when we started the week. Because in a factory never, it's like Cairo, like the cities that never sleep. Okay, so my manufacturing plant never sleeps, keeps working 24 hours. I've seen it in BASF and few other places where they manufacture like I think any factory that works for 24 hours, or I mean even if it works for 8 hours a day, at any point in time there's not a point in time when the factory doesn't have some unfinished work there. So even if you work 5 days, just 8 hours a day, at the beginning of January or beginning of any week or any month, you will have some raw materials inventory there, unless it's the beginning, unless it's the inception, like the first day when you open your factory. Okay, all other times there will be some work in process, half finished goods, half finished projects, and at the end of any period, there will be some half finished projects too. So all the things that we have thrown in during this period, plus the beginning work in process, gives us work in process, total work in process for the period. And then once you subtract the ending work in process, you now have cost of goods manufactured. Remember, total manufacturing cost plus beginning work in process minus ending work in process gives you cost of goods manufactured. All right, so the goods are now manufactured, they are now ready. Then we need finished goods adjustment, because at any point in time we had some finished goods on the 1st of Jan. So those should be added to what I have produced now. Let's say I had already 5 cookies or 5 boxes of cookies, and then tonight we made 50 new boxes of cookies that are ready to go. So total 55 boxes would be there in this period. So we call it cost of goods available for sale. I'm not hanging on with my original 5 boxes. I don't want them to go stale. I would have already sold it. I think I'd have sold them already. But the total goods, the total cookies available for sale would be 55. Do you see that? So at the beginning of this period, I have 5 boxes of cookies ready, finished goods in my shelves. And cookies are durable. They're not that perishable. So 5 boxes at the beginning of the period as finished goods, plus we had supplied 50 boxes from the kitchen, from the ovens to the display shelves. So that's 55 boxes available for sale. We call it COGAS, cost of goods available for sale. So I'm holding it steady. I'm trying to hold it steady. You see, cost of goods manufactured plus your finished goods, beginning finished goods, gives you COGAS, cost of goods available for sale. And then minus your ending finished goods gives you what? Gives you, that's the ultimate, isn't it? Cost of goods sold. Okay, so this is our cost of goods sold schedule. I promise there will be questions from it in the exam, and one of the questions we typically ask is that we like to find out the value of finished goods inventory. Let's say there's an accident, there's a fire or something, and we don't have all the information that we need to find out the cost of finished goods that were there, or cost of raw materials and work in process and finished goods that were there to claim from our insurance company. So use forensic accounting, we use our knowledge of accounting, and we work back and forth, sometimes forward, sometimes backward, to find out exactly the amounts of ending finished goods, ending raw materials, and ending work in process. Because that was there when the fire, unfortunately, God forbids, the fire occurred. See, this schedule has all those, each of those 3. It has here, it has ending See, minus ending finished goods. Oh, yeah, all my minuses, you can see, are in reds, and all my pluses are in green. So remember, minus ending raw materials, here ending work in process, and here ending finished goods. So these three might be missing, and few other information will be missing, but some information will be given, and your job would be to complete the schedule. Once you complete the schedule, you'd be able to tell us exactly what these three numbers are. Those, to avoid any confusion, there was a hypothetical question, but questions like these were there in past years, and I'm hoping to set one like that this year too. So we are going to use this schedule to work out our numbers. All right. So this is the final slide. Our learning points. See, not a lot. I must thank you in advance for being with me. So these are the learning points. We now know what prime cost is. So tell me what is prime cost? Prime cost is the total of material, direct material used, and direct labor used. Actually used, not direct materials purchased or direct materials available. It's direct materials used in the job and direct labor used in the job. So direct material used plus direct labor used, the two together is prime cost. And then with prime cost, if we add manufacturing overhead, manufacturing, not selling and distribution or administrative overhead, just manufacturing overhead, then you get the total manufacturing cost. But here is conversion cost. If we add direct labor and manufacturing overhead, labor and overhead manufacturing, that is, the two together is conversion cost. Because we had materials and someone needed to put efforts there to convert. Like you guys, you enroll in a course and we are converting you into accountants, into cost accountants or management accountants or MBAs. Okay, so these schools, colleges, and universities, these are like factories where we apply labor. You're the material. We apply labor and overhead to convert our materials into finished goods. Okay, and all the time we have some work in process, like second year students, sophomores, seniors, juniors, who are work in process. And all the time we have finished goods ready to go, like our graduates who are now waiting to go and start working, to join different jobs, or who are now applying for jobs. All right. So if a university is a factory, then you can see whether you now can answer these questions. What is prime cost, material and labor? What is conversion cost? So don't add prime and conversion to get total manufacturing cost, because there would be double counting of labor. Labor is both in prime cost as well as in conversion cost. So if you tell you the conversion cost and the prime cost, and then we tell you the total manufacturing cost, you should be able to find out the individual ones, at least the overlapped one, labor. All right, so once you have that, all three together is total manufacturing cost. And then I also would like you to point to think of the difference between cost of goods manufactured versus total manufacturing cost. Total manufacturing, total cost of manufacturing, like all the manufacturing activities, and cost of goods manufactured, because cost of goods manufactured means that doesn't include any work in process. So total manufacturing cost, once adjusted for beginning and ending work in process, gives birth to cost of goods manufactured. And then once that is adjusted for finished goods, beginning and ending, that gives birth to cost of goods sold. Because cost of goods manufactured and cost of goods sold are not the same. Let's say we have manufactured 1,500 graduates, but we have sold only 1,000. Only 1,000 of our graduates have started jobs already. The other 500 are still looking for jobs. So the 500, until they get their jobs, they are our finished goods. They're not sold yet. You see my point? So there's the difference between cost of goods, like the total number of students graduated, manufactured, taught, and awarded degrees to, versus total number of students who are now working. So once you have started your job or started your business, then you are sold. the money that is spent behind you is our cost of goods sold. And the money that is spent behind those who are still looking for jobs or looking for another education, like another master's or MBA or other professional degrees or research degrees like PhDs or others. They're also for until they start another qualification, they're also a cost of goods sold. They're also finished goods. All right. So I hope you find it useful. This is all we have for chapter 3 of Garrison textbook, cost flows and external reporting. Why external reporting? Because cost of goods sold goes into income statement, ending finished goods, inventory, work in process, and raw materials. Those all three go into the balance sheet as closing inventory, and all three go into our income statement as well. And all the three beginning ones, the beginning raw materials inventory, beginning work in process, and beginning finished goods, all three also go into the income statement. And they will have featured in last year's balance sheet. So what's last year's closing stock of finished goods, work in process, and raw materials is or was the beginning stock of this year. And what is this year's closing stock or closing inventory is going to be beginning inventory of next year. So some of these elements that we have discussed tonight actually do feature in our external financial reports, annual reports, in our financial statements. All right, so that's all tonight. Enjoy your evening, and I hope you find it useful. See you again in our next video.